Okay, Trevor,
Hello.
we are we we are live. I'm obviously at the airport here, and I think you've been enjoying some time with family, right?
Yeah, it's been a good holiday break. It's nice to always have a few days off, and because we know we've got a lot of work heading up into this year. We've got some big changes on both fronts, both with Entrepreneur Mortgage Solutions as well as with the Inspired Method, doing a little rebranding. And yourself, you're headed off to United Arab Emirates today, going to Dubai. I mean, you'll probably be there in what, 24 hours, 27 hours, however long that trip is. But
That's a bit of
what is your goal this time?
it's a bit of a trip. So this time we're going to go there. I'm going to go through the immigration process and get my residency card and get some bank accounts set up, and that's the goal. So I'll be there almost a month this time. So a little bit of a trek, a little bit of a journey, but
Yeah,
wanted to keep going on here and give people a couple of tips for the viewers have been nice and tuning in and watching our videos and hitting subscribe. So we got five year-end tax planning, Canadian tax planning tips. So
perfect.
now these are, the people who are watching here, like a lot of you are not clients, and I don't know your situation, right? But these are considerations that you should take into consideration. And they may or may not be appropriate for you. I can't give you tax advice because I don't know who you are and what your circumstances are and what your objectives are. But these are five things that you really should be considering, uh, that if they're applicable to you. So, I, I mean, the first one, Trevor, is start an FHSA, start a first time home savers account. Like
As long
that.
as you qualify, right? As long as you meet the criteria, FHSA is good.
That's right. If you have not owned a home before, or if you not have not owned one in the last 4 years, the first time home savers account might be for you. And even if you do not have any money to contribute, you should start the account because the contribution room, it's not like your TFSA where you just get it for being a resident and being alive that year. It's like you only get the contribution room for your first time home savings account if you start the account. Okay. So even if you're thinking like, I'd like to, save for a new home, I'm not going to do it this year. It's like just start the account. That room will carry forward, your 2024 room will carry forward into 2025. So it's an $8,000 annual contribution limit. But if you start the account before January 1st, then you'll have 16,000 that you can contribute next year. So, it's a fantastic savings vehicle. I rag on RRSPs all the time because they're overused, but this one is probably still underused just because of the education factor. So
Yeah, FHSA is a really good instrument because unlike RSPs, you don't have to pay it back.
yeah, you're just going to get a tax deduction on the contribution in. You take it out to buy your first home. It's going to be a tax-free withdrawal, and not just you're not able to just take out whatever you put in. You're able to take out the accrued growth on that as well too.
Yeah,
So I mean, theoretically, you can contribute 40, but you could withdraw much more than 40. So um, really important. Okay, so that's number one. Open your FHSA if you don't have a house. Okay. Number two, you need to use your FHSA room. So the room only carries forward for 1 year. For those of you who started the account in 2023 when it first opened, if you do not contribute the first $8,000 by before January 1st of this year, your 2023 contribution room will be lost. Your 2024 will still carry over to 2025, but you can only carry over the contribution room for 1 year. So if there's a way that you were going to use that room, it's kind of use it or lose it type of thing. That's got to be done by before January 1st. So that's one and two. Thing number three is, what we call tax loss selling. So it's really, this is not something that you probably should have a lot of, especially if you're a disciple of how we recommend people acquire assets and build wealth. It's like the goal is to actually acquire wealth, acquire assets that you want to hold on to for 100 years, as I say. And
yeah,
even though we're not going to live 100 years, if you buy assets that you think would be good to hold in your family for 100 years, you'll probably make wise investment decisions. But for those of you who didn't, any losses that you trigger before January 1st, they're going to offset any other taxable capital gains. So if you sold a property or sold any stocks in an unregistered account, if you sold any crypto, well, now's the time to think about that crappy investment you made in those weed stocks. Man, you know how many clients came in and thought they were going to get rich off of buying a weed stock? It's like, geez,
Think about a
yeah,
bunch of stoners running a business.
yeah, it was just going to be like the next weed was going to be the next internet. Like it was just it was so ridiculous. How many clients thought this was a great idea, and you
And
see
only
them.
the Canadian government can sell weed and lose money, right?
Holy smokes, yeah. Like so many. So you got that, and then you have your super you know all the other cryptocurrencies, all the other 20,000 cryptocurrencies, of which 19,900 of them have just lost money. So if you bought one of those and you have another gain, it's like maybe now's the time to decide if like you want out of that. You want out of that position. So any loss that you can trigger before January 1st will offset any gains if you have any gains. So like if you sold, a piece of real estate that's not your principal residence, if you have a capital gain uh, in a non-registered account, so not in an RSP, not in a TFSA, not in an FHSA. If you have a gain there, and not just an accrued gain, but an actual realized gain, so you actually sold something, you can consider selling other assets at a loss if they're a dog and it's time just to try to get out of the trade. That's one thing to think about. And then we do have we talk about RSP contributions, and I'll take it to my grave. RSPs are a scam. They're a scam because of how they're sold. Okay, not because they're not a tool. So RSP contributions can be a tool, but they're a tool for if you're trying to defer tax. So normally the goal in this is if and you have beyond January 1st. You have beyond December 31st to do this. You have the first 60 days of the next year if you have the contribution room. But the tool that RSP is if you're in a higher tax bracket this year than you expect to be in the near future, in future years. And here's where people get it wrong. They think when I'm going to be retired, I'm going to be broke. It's like, no. At a minimum, you're going to be in the first tax bracket. You're going to be collecting CPP. You're going to be collecting OAS. You're going to have possibly some income coming in. So you're going to be in the first tax bracket, probably paying 25%. So, and you got to think, is that the goal? Am I acquiring assets to have no other income? Do I not have any rental income? If you're trying to build a rental portfolio, do I not have any unregistered stocks that are paying me tax efficient eligible dividends? Do I not have any of this? Do I not hold any Bitcoin that I can sell? Do I not hold any gold that I can sell? And so RSPs tend to be a tool. People just assume that they're going to be a 0% rate when they're retirement. I mean, the best case scenario is you're in a 25% rate. So
Yeah.
What you need to think about is the RSPs tend to be a tool, and your goal shouldn't be to be in the first tax bracket in retirement. That's actually just a whole failed plan that people have. It's just well, I'm going to have less than $60,000 of income per year in retirement. I don't want to be on the CBC complaining that I can't pay my property taxes. So the goal should be to be beyond the first tax bracket, to have passive income sources that are going to push you beyond the first tax bracket. So think about, but this is someone who has a large gain, or they have some sort of bonus, or they're moving from one job to another. RSP contribution. Think you're making 200,000 this year, and you expect that you're only going to be 80 to 100,000 for the rest of your life. Okay, that's a good deferral. That's a good deferral tactic. So you have to understand, it's am I going to be in a dramatically lower tax bracket in the near future? And potentially you could say in the long-term future, but I would say this is where most people get it wrong, because they just think that they're going to be broke. Keep in mind the tax brackets go up by the fake inflation rate, the fake CPI every year. This year, it's I think it's around 2.5%. But the desirable assets that you want to buy are going to go up faster than that. So, even if you're kind of at the same purchasing power and your income level, because you're increasing your skills, you're probably in a higher tax bracket.
Yeah.
So,
well, one thing that should probably point out is that even if you make a contribution to an RSP, you don't have to buy the bank's products. You can self-direct, and you can invest that into some good Canadian dividend-paying stocks where you can actually get decent gains.
Yeah. So I would say it's do you expect to be in a dramatically lower tax bracket? in the next 1 or 2 years. It's something that you can realistically project. And then if you're looking long term, it's like, are you beyond the second tax bracket? Are you beyond the second tax bracket where you actually think you won't have that income level in retirement based on what you're doing? Okay, that's when you consider an RRSP contribution. But most people are contributing to an RRSP and they're in the first or second tax bracket. Almost all of them. It's like, probably 90% of the contributions are made with a deduction in the first or second tax bracket. And it's just not really efficient. You're just converting efficient investment income, whether it be capital gains or eligible dividends, tax at a lower rate, to a full other tax RRSP withdrawal. So if you want to learn more about that, of course, sign up for the bootcamp and we'll walk you through that. But so you're going to consider, for the purpose of this video, I'd be considering RRSP contributions if you expect to be in a dramatically lower tax bracket in the short term, or if you think you have an income level now that's not practical in retirement. Okay, maybe you're making $250K a year. It's like, okay, you might not have $250K a year passive income in retirement, but you shouldn't be at 30, because if you're at 30, you failed. Like, the game has failed. That's not an effective retirement plan. And the next thing you need to think about is the converse of that is the RRSP withdrawal. And this is probably the single biggest one that everyone forgets, is the RRSP withdrawal. So, coming up to December 31st, it's, if you are in the first tax bracket, if you are in the first or even second tax bracket, you got to think, it's like, what's my income trajectory next year, the year after? What's my income trajectory when I'm older? Generally speaking, if you can get money out of your RRSP and you're still in the first tax bracket, so you're still under $60,000 a year in income, it's like, generally speaking, that's something that you should consider very strongly. Because what you don't want to do is you could have drawn that money out of your RRSP and paid 25% tax right now, and you could potentially fund a TFSA and have all those future gains accrue tax free, instead of you leave it in there and you're successful for the remainder of your career and your remainder of your working years, and you're eventually going to take that money out of your RRSP at a higher tax rate when you're older. And so that always happens. So people have to really, so when I say RRSPs are a scam, they're not, we don't ever use them. It's not that they're not a tool that we don't use. It's just, they're a tool that generally we use in 10% of the cases instead of 90% of the cases.
Right.
And conversely, it's like the money that's in there, like, we know what it is. It's like, that money is basically a joint account between you and the government. At some point, you're going to pay tax on it, and it's very unlikely you're going to draw any substantial funds out of it at lower than the first tax bracket. So what tends to happen is people actually contribute in the first tax bracket and end up drawing later in life in the second tax bracket or beyond. That happens way more than people think. The highest tax bracket that most people ever enter is the year that they die, when they're deemed to have sold all their assets. And in which case, so the goal isn't to die with a whole bunch of RRSPs, because that's not an effective wealth transfer strategy, because that's coming at the highest possible rates. So, So those are kind of the 5 things, Trevor, that I think people need to think of: is, start your FHSA, make sure you use up your FHSA contribution room from 2023, because that's about to expire at the end of the year, and then consider any tax loss selling. If you do have any taxable gains this year, so if you have any assets that are in a loss position, you consider that. And then, consider RRSP contributions, but, consider them, on the pretext is like, am I certain that I'm going to be drawing this money out later in life at a lower tax rate? Because a lot of times that's not the case. And then number 5, and then often the most forgotten about, is, are you considering RRSP withdrawals? If you're in the first tax bracket or a lower tax bracket than you expect to be in the near future, and even over the long term, you should consider unlocking some of that money and investing it in more tax efficient means, whether that be a TFSA, or whether that be just buying and holding plain old boring dividend paying stocks, but extracting the eligible dividends in a more tax efficient manner with the dividend tax credit. So So those are the five considerations that people need to think about. Those, they might be, for some of you, you might understand exactly what I'm talking about. You've been to 3 or 4 boot camps and you got it locked in. And for other of you, you might need to go and do some research. But these are the five things that I can't tell you to do because I don't know who you are, but you should consider them. Okay, you should consider them. You got a couple days here, and even if you're watching this video in the new year, most people, these are kind of tried and tested things that people can do. So does that make sense, Trevor?
Yeah, that makes perfect sense. Thank you so much for taking the time out today. It's no days off. We're always on for our guests, always on for our podcast audience, and bringing value to them. Next week, we're going to be coming live from Dubai, and it's going to be pretty interesting. So I'm looking forward to seeing you then. And let's get ready. And I just want to wish you a happy New Year before I see you again.
Right on. Happy New Year, Trevor.
Take care.
Bye bye.